to this, the first financial planning update of the year for January 2022. Where did that month go? So we're recording this on the 1st of February. To get started, I'm going to have a review of the markets for the whole calendar year last year. So this is calendar year 2021. We can see a familiar story here repeating itself really in the fact that the S&P 500 was by far the best performing global market, delivering nearly a 30% return year on year in 2021. Bearing in mind that was recovering some losses from the previous year, 2020, when we suffered the worst of the damage from the coronavirus pandemic, but nonetheless an impressive result. The world index, which of course takes into account not just the UK and the US, but the vast majority of global stock markets, delivered around a 23% return. And the FTSE 100 unfortunately did end the year as one of the more poorly performing global markets, delivering an 18% return, which is still not to be sniffed at. However, that was a reversal of fortunes. If you track back across the graph towards the middle of the year, you can see actually that the FTSE 100 was pulling ahead at one point, and it looked like it may make an escape from the other two, but unfortunately that trend was reversed later in the year. In terms of how that translates into portfolio performance, a very successful year on all of the portfolios, the balanced portfolio being by far the most popular, delivering nearly a 10% return across the year, which is well ahead of our usual targets. Even the more cautious passive portfolio delivering around a 5.5% return. Bearing in mind that cash is probably paying roughly 0.5% at the moment, these are very, very impressive returns when we put it into that sort of context. Now, also an interesting comparison is always the active versus the passive portfolio. As we can see, they have traded places somewhat throughout the year, but the final position is that the passive portfolio was marginally ahead by around 0.5% at the end of December. Now, turning our attention to January, we've had a very interesting start to the year. FTSE 100 actually one of the best performing markets if we look at the month of January, in fact posting positive returns, whereas both the US and indeed most global markets have had a slightly less happy time during January, S&P 500 posting a loss of just over 4%. So that's mainly driven by falls in US technology stocks, which we'll explore in just a moment. But it's an interesting trend. Of course, only 1 month that we're looking at here, so I think it's a bit early to draw any firm conclusions, but it is nice to see the UK market pulling ahead. So I think there's a few things we need to be mindful of in markets in the coming months. The first issue, which we're fairly comfortable with now, is inflation. I think it's becoming increasingly clear that the current bout of inflation is not as transitory as originally thought, and there might be some more embedded inflation now working its way through the system, being driven by what are now fairly familiar issues, problems in supply chains, shortages of materials. Microchips is a fantastic example of shortages. In fact, there's a report in the media today on the impact that's had on Land Rover as a business. So supply chain shortages definitely causing an issue in some sectors. We've got increasing tensions in Ukraine and Russia. Of course, that may have an impact on markets. Markets don't seem to be too concerned with that at the moment, but of course that's an issue that could develop, so we need to keep a very close eye on that. We have to question Boris Johnson's future, given revelations in the last couple of days. Of course, there is now a police investigation into the parties and gatherings during lockdown. So it remains to be seen what that means in terms of the Prime Minister's position and whether or not we will have a leadership contest. But again, something we do need to be watching very carefully. And as I mentioned, US technology shares have really been the main sort of casualties of the last month, January 2022. And the fall in those shares is perhaps not entirely unexpected when we consider their stratospheric rise during the whole of last year, really. So given the falls that we're seeing, I think in most cases it's very fair to describe it as a correction. I certainly wouldn't call it a crash or anything more entrenched at this stage. I think perhaps just the market cooling off ever so slightly following what has been a very, very impressive year. With that said, although interest rates may increase next year, the prospect is that interest rates will still remain relatively low by historic standards, and it's probably reasonable to assume that the returns on equities are going to far outpace those on cash and bonds. So, as usual, a continuation of a theme that's run really since the financial crisis back in 2008. Equities will really be the main place to look for real returns on capital. Now, as is becoming a trend, we're also going to explore a slightly more advanced inheritance tax or financial planning concept. So today we're going to have a look at an inheritance tax investment followed by a gift, either to an individual or to a trust. Now, most people will be familiar with the traditional 7-year gifting rule. So in most cases, when you make a gift of capital, either to an individual or to a trust, you then have to survive for a 7-year period before that gift falls out of the estate for inheritance tax purposes. And of course, in some cases, 7 years feels like quite a long time. In addition, there's a soft limit of £650,000 in terms of the amount that we can gift into trust. That's for a couple. It would be £325,000 for an individual. And again, this can put people off making gifts sometimes in order to reduce their inheritance tax liability. So the various inheritance tax investments can actually be used to address both of these issues. And we're going to explore some more of these in future sessions, but for today I'm going to think about a portfolio of AIM shares, which, although it is a somewhat more adventurous investment strategy, it's far less adventurous than some of the other options that exist in this inheritance tax planning space. So we've got Jack here. Let's imagine he's got 100,000 in cash. He would like to remove that value from his estate. He's thought about gifting it either to one of his children or to a trust for their benefit, but he's somewhat put off by the 7-year waiting period. So what he can do is he can invest that money into a portfolio of AIM shares, and then there's only a 2-year waiting period required before it qualifies for inheritance tax relief. So in this case, the net cost to the beneficiary of that investment is only £60,000. Of course, had Jack kept the money in cash and then passed away, 40% would have been lost in IHT, whereas with the shares, they would benefit from the full 100,000, plus any growth, of course, that had been achieved in that portfolio as well. Now, if we're thinking about an AIM portfolio, we do need to be slightly careful. Not all AIM shares qualify for relief. There is a substantial minority that don't. There's no income tax relief. AIM shares are, however, far more liquid than either Enterprise Investment Scheme or Seed Enterprise Investment Scheme. Those are some other options we're going to look at in future sessions. As we've mentioned, there's this exemption after a 2-year period, and there's roughly 1,000 companies on the AIM market to select from. And as I say, most of those, not all of them, but most of them will generally qualify for business property relief. So although we are restricted to a single market, the AIM market, which of course is a UK stock market, there is a wide range of firms, so it is possible to build a well-rounded and diverse portfolio. Now, once that investment has been made and the 2-year holding period has passed, this is where things get even more interesting, because at that point you can make a gift of the shares either to an individual or to a trust, and it then qualifies as an exempt gift. So there's no 7-year waiting period, and that the fund falls then completely outside of the estate. And in addition, for gifts into trust, it's worth mentioning that the £650,000 limit for a couple no longer applies. So in theory, you could invest, let's say, £1 million into an AIM share portfolio and then gift that fund into trust. Now, it's important that the beneficiary takes advice if they're in receipt of a gift of this nature, because if they sell the shares too soon, that can bring them back into account for inheritance tax purposes. So very, very important that advice is taken once that gift has been made. But this sort of planning is very effective for accelerating the process of removing assets from the estate. We generally have a 2-year period instead of a 7-year period, and it can also be used to overcome the limit on gifts into trust. So that's everything for today. I hope that's been beneficial, and look forward to seeing you again on the next session at the end of February.